Hello everyone. Welcome to video 7 of chapter 5. In the last video, we talked for a while about the rules around dispositions of depreciable properties. In this video, we're going to rehash some of those rules and do some calculations so you can see it in action, and hopefully that'll help drive home the point and help you understand what's going on. Just to review, when we dispose a depreciable property, we recognize it in the class rate, the UCC of the class, by subtracting the lesser of proceeds of disposition or the capital cost of property. Because the capital cost represents the asset we originally put in the bucket, we can't take out more than we've put in. So capital cost is always the limit for how much we can take out when we sell a particular asset. The proceeds of disposition, it's much more likely you'll sell something for less than you paid for it, but it might be somewhere between your UCC. So we always subtract the lesser of capital cost or just what we got for proceeds of disposition. So if we bought something for $100 and we sold it for 60, that $60,000, the smaller amount, that will get subtracted from UCC. The subtraction usually lets us know whether or not we should consider recapture. Now, CCA is only claimed if the UCC on the last day of the tax year is positive and properties remain in that class. Because CCA usually has specific rates, for example, class 10 has 30%. If after our dispositions UCC gets to $0, 30% of $0 is 0. So once UCC reaches 0, we don't commonly do the CCA calculation only because we know it's going to amount to nothing. The other thing about that is to note we always deal with additions and disposals before our CCA calculation. So we have our opening UCC, we'll deal with any additions or disposals, and then we'll have a resulting UCC. Only if that number is above 0 will we have a CCA calculation. Because proceeds get subtracted from our UCC, if proceeds are ever above that value, subtracting them will create a negative number. So recapture occurs whenever a disposal results in a negative UCC. That means we've subtracted more than the value that was left. So we need to recognize that lost value or missed value. Terminal loss occurs when UCC is still positive, but there's no property remainings in the class. If after our dispositions, the bin is empty, but there's still UCC left, we have to recognize that terminal loss to get it to 0 because we can't amortize something that's not there. So, some math. Davis Limited has 2 properties in Class 8 with a capital cost of $50,000 each. In the prior years, Davis Limited has claimed CCA of $63,136. So that means the UCC at the beginning of the year must be $100,000. We have 2 properties, $50,000 each, so $100,000 was put in total. We subtracted CCA of $63,136, which means our UCC is what's left, $36,864. If we sell one property for $40,000, then, yeah, we'll just leave it there. So 36,864 is what's left in our bin. When we subtract our proceeds, that creates a negative number. So our CCA was supposed to be reflecting a loss in value, but someone paid us more than that remaining value. So we've taken too much CCA. So that negative number needs to be added back to income as recapture in order to get our UCC back to 0. So 3,136 plus recapture of 3,136, our UCC is 0. We don't need to take a CCA calculation. So that's what's showing here. One property sold for 40,000. Our UCC balance minus our proceeds creates a negative number. That negative number needs to be added back to income as recapture. With UCC now 0, no CCA will be claimed. The recapture, it says the recapture is added to the UCC in the following year. That add back is what gets our UCC to 0. All that it is saying is that inclusion and income also gets added back to the UCC. Now, recapture with capital gain. Instead of one property sold for 40, we sold one property for $60,000. Now, the recapture, instead of recapturing from 36 to 40, we will recapture 36,000 to 50,000 because that's our original capital cost. So our disposition is at the lower of proceeds or capital cost. Our original cost was 50, proceeds was 60, so we use $50,000. Our recapture is now 13,136, and that extra $10,000 above what we originally paid, that is capital gain. So 13,136 will be added to our income as recapture, and another $5,000 will be added to income as taxable capital gain. Now we have, again, two properties, 50,000 each. We're going to sell both properties for $20,000. We had 36,864 of UCC left. We disposed of $20,000, the lesser of 20,050. So we still have 16,864 left in Class 8, left in our bin. But we just got rid of all of our properties. So this 16,000 can't be amortized because there's nothing to amortize. So we need to get rid of it. And we do it by deducting it as terminal loss. We won't take capital losses. We won't take CCA. We will just deduct it fully as terminal loss. But this only applies if no properties are left in the class. In the following year, terminal loss gets deducted from UCC. That's just saying UCC will be adjusted for the terminal loss claimed, meaning UCC will go to 0. Okay. Let's get to our exercises. Exercise 5-10, 11, and 12 is 3 exercises to demonstrate the results of a disposition. They specify which it is, so we're going to see capital gains in the first, recapture in the second, terminal loss in the third, and then the final 5-13, they're just going to give us some values and we'll see where it comes out to. So 5-10. On January 1st of the current year, Hassan has a Class 8 opening UCC balance of $275,000. During the current year, property with a capital cost of $18,000 is sold for $23,000. There are no other dispositions for the year, and there are numerous other properties remaining in the class. What are the income tax consequences of the disposition? So we always need to know what was our original cost of the asset that was put into the bin, the original cost of the property, and then what proceeds did we receive from it? Since we received more than it originally cost us, our disposition, our subtraction from UCC is going to be the lesser number. So our UCC balance says there's 275,000. It just says numerous. Let's say there's 100 other assets in the bin. We're selling one of them. So disposition is the lower of these two numbers, 18,000. The 18,000 will be subtracted from UCC. Since UCC is still positive, and since UCC is still positive and we still have items left in the bin, there's nothing for us to do. Yes, there's still UCC remaining, but we would associate that remaining UCC to be applied to the other 99 assets in the bin. So there's nothing to tell us that the remaining UCC or the proceeds received for our asset are necessary for adjustment. We have 257,000 of UCC, so we're not going to worry about it, but we do have to worry for that $5,000 of proceeds above what we paid. The proceeds, the capital cost gets subtracted. The remaining $5,000 becomes a capital gain. So our taxable capital gain is $2,500. So when we sold this asset, nothing happened Well, I mean, we subtracted it, but we're not making any recapture or terminal loss adjustments. We're just recognizing that $2,500 of taxable capital gain. 511. In the beginning of 2025, Patel Inc. has two properties in Class 8. The capital cost of each was $27,000, and the Class 8 opening UCC on January 1st was $24,883. On June 30th, one of the properties was sold for $28,500. No other additions or dispositions. The depreciable property are used in business carried on by Patel. What's the effect? The original cost was $27,000. We sold it for $28,500. If our proceeds are more than our cost, we know capital gains are going to be involved. The amounts less than capital cost is what we'll consider for recapture and terminal loss. So our capital cost was $27,000. That's how much we originally put in this bin. Our proceeds were $28,500. Now we can't dispose of more assets than what we put in. So our disposition can't be the $28,500 because it's too high. We will subtract the $27,000. We had two properties in this bin. So after our disposition, there's still a property left. So we're not going to close out Class 8, but we do have to deal with the disposition of the one we sold. $24,000, 24,883 is our UCC balance. When we subtract $27,000, we're subtracting more UCC than what's available. That insinuates that this UCC balance is too low. It's recognizing we've recognized too much CCA. We've reduced CCA or reduced the UCC to below the real value of the asset. So if we've taken too much CCA, that means we've deducted too much from our income. So that recovery needs to be added back to income. So if UCC is ever negative after a disposition, 24,883 minus 27,000 is negative 2,117. UCC becomes zero because that 2117 gets added to income. So that addition to income gets added back to UCC. So next year, since we do this before the CCA calculation, we'll be using 20% of nothing. So there's not going to be any CCA this year. We're going to have a recapture added back to income of 2117. And our proceeds was more than our original cost. We sold it for $1,500 more. That's a capital gain. The taxable capital gain is $750. So the income effect is we will add a total of $2,867 to our income. 2117 of it comes from our UCC recapture. 750 comes from our capital gain from selling it for more than we paid for it. (5-12) Terminal losses. At the beginning of 2025, Patel Inc. has two properties in Class 8. The cost of each property is $27,000, just like the last question. The opening UCC balance is $24,883. On June 30th, both properties are sold for $9,000 each. That's a total of $18,000, no other acquisitions or dispositions. So what happens here? What happens here is the proceeds were $18,000. That's less. It was $9,000 each. Each asset was $27,000. Total capital cost of $54,000. The proceeds were significantly less than our original cost, so the proceeds is what we will subtract from our UCC balance. After this transaction, there's no assets remaining. We had two properties, and then both properties were sold. So our UCC balance was $24,883. We took out $18,000. Now our class bucket, our class bin, our UCC says there's still $6,883 worth of value left to be reduced, left to be consumed by CCA. But we have no asset, so we're not going to take CCA. So that positive amount has to be adjusted to zero. That is adjusted to zero by subtracting 6,883. So that subtraction has to be recognized in income. So our income effect is we will subtract from income $6,883 of terminal loss. So when UCC was negative, we added income to get it to zero. When UCC was still positive, we subtracted income to get it to zero. So whatever we do to UCC to adjust it, to correct it, that also has to be done to income. 513. Norkey Limited disposes of a Class 8 property for proceeds of $126,000. The capital cost of the property was $97,000, and its carrying value for accounting purposes was $43,500. The company's Class 8 contains a number of other properties, and the UCC balance at the beginning of the year was 2.462 million. Lots of properties, lots of UCC to deal with. Briefly describe the accounting and income tax treatments of the disposition. I don't want you guys to worry too much about the accounting side, but let's discuss the tax side. The UCC balance of 2.4 million, almost 2.5 million. When we deal with disposition, there's going to be lots of UCC left. And there's still lots of other properties. So we're not going to worry about terminal loss. UCC, as long as there's still properties, we're not worrying about terminal loss. Since UCC is not going to get below zero, we don't need to worry about recapture. Recapture comes into play if UCC goes below zero. So we have proceeds for more than our cost. So just by reading the question, usually we can figure out, is there capital gain? Is there recapture? Is there terminal loss? So because UCC is still positive, there's no recapture. Recapture comes into play when UCC goes negative. Because we still have assets remaining in the bucket, there's no terminal loss. Terminal loss only occurs when there's nothing left in our bucket, when all the assets are sold. So no recapture, no terminal loss. In this disposition, the only thing we're dealing with is the capital gain. Our UCC balance will subtract the lower of capital cost or our proceeds. 97,000 is smaller than 126,000, so that will be subtracted. The capital gain occurs when proceeds are more than capital cost. So this is a difference of $29,000. That gets added to income, 14,500. So 50% is included. This is different from the accounting treatment because from the perspective of accounting, we just take whatever proceeds we got and compare it to our net book value. It says our book value, the carrying value for accounting purposes, was 43,500. So we say, okay, on our books it was 43,500. We sold it for 126,000. So our financial statements will say there was a capital gain of over $80,000, 82,500. But on our tax return, our taxable capital gains only 14,500. So when we're dealing with dispositions of depreciable property, our financial statements can differ greatly from our tax returns. Some employees are eligible to claim CCA. Certain employees can claim their musical instruments if they're a musician, if they have a car for travel as a salesperson, if they use aircrafts, they can take CCA. But if they sell something for more than its UCC balance, that recapture is employment income instead of business. Because normal CCA calculations are subtracted from business income. But if you're taking CCA on an employment-related expense, that's subtracting from employment income. So if we have recapture, that needs to go back to the correct income type, employment income. We don't have terminal loss deducted by employees. When we sell an asset, that terminal loss is supposed to recognize a reduction in value that should have been reflected in income. When an employee has their own property, that additional UCC that's left is considered to have been used personally. So it doesn't get subtracted from income. So employees will still handle recapture, but not claim terminal losses. There is a calculation for recapture for class 54, and the rules were modified so that class 10.1 could use this as well. The reason there's a special case for these two classes is because they have a limitation. Sorry, let's go here. They have a limitation of what can be added to the class. 10.1, a new property can't add more than 38,000. For class 54, you can't add more than 61,000. So what they say is figure out the percentage. Let's say we bought something for $150,000, but we could only recognize 61,000. So our class adds 61. We paid 150,000. So we recognized or we capitalized only 40.667%. The amount we put in the class was this percentage of the property. So in the future, if we sell the property, let's say we sold this for $110,000, that $110,000 of proceeds needs to be adjusted for the amount of the asset we put in the class. So if we take, so since $61,000 was put into the class, the same percentage times our proceeds is 44,733. So it's as if saying of the 110, or let's start at the beginning. Of the 150,000, we capitalized $61,000. Therefore, of the 110,000 of proceeds, 44,733 applies to the disposition of our class. So we keep that percentage the same for our capitalization and our disposition. So 61,000 is the maximum for 54. For class 10.1, we would use 38. So $38,000, we spent 150,000. 25% is what made it into the class. So that's the amount of our proceeds we can consider for disposition, 27,866. Class 14.1 disposals has regular CCA rules, but 14.1 is where we put goodwill. With respect to capital costs, all additions to goodwill have a single capital value. Normally, when we add assets, each item keeps its capital costs. I had a chair that was worth $600, a desk that was $1,200, a couch that was $3,000. They each keep their cost. But when I'm buying businesses that include goodwill, that goodwill keeps adding, and we're considered to have one goodwill that has the capital cost of all of them added together. This assumes goodwill acquired with a business will be absorbed into the acquirer's operations. If the acquired business is operated separately, the goodwill will be allocated to a separate class 14.1. So you'll have one goodwill per business. Terminal loss does not occur for 14.1 until you sell the whole business. Okay. It's 20. Okay, let's end that here. I'll have another video of just a couple minutes just to summarize the dispositions, and then we'll finish off the chapter with separate classes. Thank you for your time. See you in the next video.